Hello, this is Darby Worley, your host for the Capital Synergies talk show for real estate investors. Capital Synergies is sponsored this week by Steelhead Capital, your commercial loan advantage. Today we have with us Mr. Dan Fasulo, Managing Director of Research for Real Capital Analytics. Good afternoon. And Dan, welcome back to the show.
Thanks for having me, Darby.
So looking back over the year 2009 and early 2010, what is your sense of recovery, if you would call it that, in the commercial real estate sector?
Well, we're clearly off the bottom at this point.
Mm-hmm.
You know, when we look back a few years from now, it's going to be clear that the first half of 2009 was the low point in the transaction cycle. It was a period, very much defined by a lack of liquidity in the debt and the equity markets, in addition to a significant amount of uncertainty in the investment community. We've already, through the first half of 2010, we've already tracked over $33 billion worth of commercial property transactions for the four core property types. And to give you a sense of how far that off the bottom that is, we tracked only about $20 billion in the same period last year.
Mm-hmm.
So we're starting to see activity pick up. We're hearing from our investors that the issue is more on the supply side than on the demand side, with a lack of availability of quality properties to purchase.
So now, and to what do you attribute that? Are people afraid to get into the market, or what?
It's a combination of factors. First, there is a backlog of distressed properties that are waiting resolutions,
mm-hmm.
and have gotten basically stuck in the foreclosure process,
mm-hmm.
or in a situation with a CMBS servicer and special servicing, and those situations are going to take a long time to work themselves out. Sometimes they take years. Mm-hmm. On the other hand, at least for the best assets in the market, your Class A properties with long-term leases in place, we've seen a situation where the market is just repricing itself now. We've seen values come off the bottom significantly. Some believe that prices have recovered 20 to 30% of their value since the low point in early 2009. Now, granted, that's for the best properties. So it always takes sellers a while to digest the new pricing universe. And I think as more and more realize that they can get X for their property, I think in the fall you'll start to see more and more discretionary sellers come to market. Combine that also with the fact that we're moving into a higher capital gains tax environment next year in 2011. I think there's going to be a lot of triggers for sellers to come out in the second half of this year.
Okay. Are there more deals being not made even now than there were in, say, March or April?
Oh, sure. June was a very strong month. A lot of buyers and sellers usually like to wrap things up before the summertime hits, but it's also been a very active summer so far. We've seen a significant amount of deals go under contract recently, which bodes well to future closings. So I expect the industry to work through the summer, and I expect another wave of new listings available for purchase after Labor Day.
Okay. Well, you made one reference to the capital gains going up next year. What do you think about the other ways that the government have become more involved with financial reform? Has that had a positive effect on the market?
I have my personal views on the subject, but I will communicate the feedback we're getting from our investors.
Okay.
And it's the fact that the economy is no longer the biggest item on their list as far as things to worry about. It's very much become many of the actions that are taking place in D.C. and the uncertainty surrounding a lot of different policies that have the ability to impact commercial real estate. Whether it's the financial regulations bill, whether it's the rise in taxes, not just capital gains, but even at the local municipality and state level, real estate's always a ripe target for capturing some additional tax dollars. So I do think that at the end of this year we'll see a greater than average level of tax-motivated sellers in the marketplace.
Okay. So of the four types of commercial property, apartment, office, retail, and industrial, which was affected the most by the hard times, and which remains the most solid investment, or maybe promises to be so in the future?
Well, no property type, got through the downturn unscathed. We went through what was very much a capital markets impact, or downturn, which impacts, debt and equity and all the different property types. It's clear as far as the recovery has gone so far that investors are targeting the best assets, irrespective of property type. They want well-located CBD office towers that are well leased to premier tenants. Same with retail and industrial properties. They're looking for the stability of long-term income. Think the bond type assets, or assets with bond-like qualities. Investors are really avoiding any type of property that is really exposed to the near-term economic environment. Multifamily has recovered very rapidly, to the surprise of many of our investor clients. We've actually gotten angry phone calls saying, how can this apartment property in Phoenix trade at a 5 cap? What is happening that the market has recovered this quickly? And it's created confusion. But, there's factors outside of real estate that are driving capital to our sector and really driving yields down again. Whether it's, debt costs, which remain historically low due to the courtesy of the Federal Reserve and the U.S. taxpayer. And then you have just other investors that have identified commercial real estate as an asset class they want exposure in. There's growing thoughts of inflation at the other end of this recession due to the amount of money that our government's printing. And, while the academic studies are mixed whether commercial real estate's an actual inflation hedge, investors seem to think so, and are looking at commercial real estate as a way of some midterm inflation protection in their portfolio.
So what do you predict on? I'm sorry. Go ahead.
No, it's just to directly answer your question. All the property types were hit really hard during the downturn, and now it's there's not really one focus, but investors on a whole are focused on the best assets in each property type, in addition to the acquiring properties in the best markets.
Okay. Now, you said earlier that you feel that the bottom has been reached in terms of pricing. What do you think, what do you predict in terms of pricing and the ability to secure financing for each of these property types for the rest of this year and beyond?
Yeah. For the quality assets, financing is available, and I would say readily available at this point. We've seen a significant recovery in the debt capital markets over the last 6 months. There's many balance sheet lenders, like insurance companies, that are active again, and for the first time, we're seeing life in the CMBS sector. Many of the former investment banks have restarted their conduit programs and are actively out in the market looking to make loans. Now, if you're sitting with a property that's 50% vacant, the lender's not going to talk to you. They just don't want any risk exposure right now to commercial real estate. However, we've heard reports of, quality Class A, fully leased properties basically being inundated with lenders willing to make a loan on those types of assets.
If you were to give some words of advice to our commercial real estate investors about the present market, what would you tell them? Do you see any silver linings ahead?
Well, the market has bifurcated into the good stuff that everybody wants and is targeting right now, and the bad stuff. Your vacant properties, your land, your suburban hotel that is having trouble staying full. But on the other side, the good stuff, we're seeing many properties undergo a situation where there's multiple bidders, both on the equity and debt side, and it's really driving up prices again to very high levels at this point in the cycle. We're seeing ultra-low cap rates in the global cities across the country, in places like Manhattan and D.C. and San Francisco. And usually it would have taken several years to see this type of recovery in values. So what I'm recommending for the first time, actually, just over the last couple of months, is for select assets in certain markets, for investors to really move out on the risk spectrum a little bit and, acquire a property with little vacancy with some upside in the near future. But, that being said, that executing on that type of strategy, especially in a challenging economic environment, takes a lot of local expertise and on-the-ground management. And I think that investors who can execute on a business plan to add value to a property can pick up some of those types of assets that need work for very attractive prices versus where they were trading at a couple of years ago. For example, there was an investor who purchased a property here in Manhattan that has significant vacancy risk in the near future, in addition to needing additional capital. And that investor was able to purchase that Manhattan office building at a 50% discount versus what the property traded for a couple of years ago. Now, a Class A office building in Manhattan that's fully leased over the long term and has bond-like qualities, you're basically seeing very little discount from the high point in the cycle.
So where can our listeners go to learn more about the reports and subscription services from Real Capital Analytics?
We have all that information on the RC Analytics website, and feel free to send us an email or contact RCA directly, and we'd be happy to help any investor with their real estate knowledge needs.
Great. And what's the URL for that website?
www.rcanalytics.com.
Great. Well, thank you, Dan. This has been a very insightful discussion on commercial real estate, and I'm sure our listeners appreciate your spending time with us today. So if you are an investor looking to finance commercial real estate, be sure to check out Steelhead Capital. Just go to www.steelheadcapital.com and submit your no-obligation loan request. This has been Darby Worley, your host for Capital Synergies. Till next time.